What's up, guys? It's James. Even though cryptocurrency isn't new tech, banks can still be a bit wary about when a customer's statement shows a lot of crypto exchange activity. Maybe your business has dabbled in using stablecoins and then suddenly your account freezes. Payroll's in 2 days, a supplier needs an invoice settled, and now you're stuck on the phone explaining what USDC is to someone who's never even heard of it. If that sounds familiar, or if you have no idea what I'm talking about but want to learn more about crypto, you're in the right place. In this video, we're breaking down crypto-friendly bank accounts. But first, we'll cover the basics: what crypto is, what stablecoins are, why businesses are adopting them, and why some traditional banks still flag crypto-related activity. And then we'll look at some of the top banking options for businesses and consumers using crypto, including what to look for in an account provider and the pros and cons of each option. Let's get into it. First, what's a stablecoin? A stablecoin is a type of cryptocurrency that's pegged to the value of another asset, which is usually the US dollar. Hence the name stablecoin, because their prices don't swing according to a market. It's what makes stablecoins different from cryptocurrencies like Bitcoin or Ethereum. Bitcoin and Ethereum are exchange traded. Their prices are set by the market and they can swing by double-digit percentages in a single week. That kind of volatility is fine if you're investing, but it's a problem if you're trying to pay for something or hold for treasury. With stablecoins, you get the infrastructural benefits of crypto: fast global settlements, low fees, no intermediary banks, without the price risk. There are many different stablecoins in circulation today, but the two most popular are USDC, issued by Circle, and USDT, issued by Tether. Both issuers back their respective coins with hard assets like US Treasury bills and other reserves, meaning the set price isn't just a number on a screen. It's designed to be supported by real underlying assets held by the issuer. There is one thing worth pointing out: stablecoin holdings are not FDIC-insured. Even if the institution providing the wallet for them is. FDIC insurance only covers US dollar deposits at banks. The same is true of SIPC insurance if you're holding stablecoins for treasury. If you're considering using stables as your daily driver for payments and treasury holdings, it's important to keep in mind that choosing a setup in a provider that gives you insurance on some of your cash holdings is really useful for hedging your exposure to a bank failure. It's super unlikely, but it's better to be safe than sorry. Now, you might be thinking, I don't even want to deal with crypto. It's complicated, it's hard to wrap my head around, and who would even want cryptocurrency that's not an investment piece? It's a fair question. And the answer is, most businesses using crypto today aren't doing it for the investment. They're using it because the blockchain can move money faster and cheaper than traditional bank rails, especially across borders. To better explain, let's break down how an international wire transfer works. Despite all the advancements in financial technology over the past 20 years, there still isn't one universal way to move money from a bank in one country to a bank in another country. The most widely used system is the SWIFT network, which is a messaging system that connects about 11,000 banks worldwide. When you initiate a wire, the SWIFT network determines what route that payment needs to take in order to reach a recipient. And then a code is delivered to each of those banks on the route required to make the payment happen. Banks that help facilitate the transaction as the middleman are called intermediary or correspondent banks. A single international wire can pass between 3 to 4 intermediaries before reaching the intended recipient. Each one takes a processing fee, each one can add a delay. The whole process can take several business days and cost $40 to $50 or more. A stablecoin transfer on the blockchain like Solana or Base settles in minutes. The fee is often just a few dollars, and it doesn't hop between intermediaries. It moves directly between the sender and the recipient. Speed and the low cost of stablecoin transactions help explain why adoption has surged in recent years, especially among businesses. The global stablecoin market supply now exceeds $300 billion, up from less than $30 billion in 2020. Real-world stablecoin payment volume, meaning the actual commerce rather than crypto trading activity, doubled in 2025 to $400 billion, roughly 60% of that driven by B2B payments. So what should you actually look for when choosing a crypto-friendly bank? There's 3 things that matter most. First is payments versus trading. Some platforms are really crypto investment accounts in disguise. They let you buy and hold Bitcoin or Ethereum, but they're not really built for actually moving money. If your goal is paying contractors or settling invoices, you'll want a platform that prioritizes stablecoins, not volatile tokens. The second is custody and complexity. Traditional crypto involves managing private keys, paying gas fees, and worrying about which blockchain network you're on. Some crypto-friendly platforms still make you handle all of that yourself. The better option is a platform that abstracts away the complexity. You see a USD balance, you click send, and the platform handles wallets and network selection behind the scenes. Third is regulatory coverage. Stablecoin regulations vary by country. USDC has structured its compliance to align with frameworks like the EU's MiCA regulation. While USDT is the most widely used stablecoin, it operates under a different framework and isn't equally accepted everywhere. If you pay international suppliers, having support for both gives you the most flexibility. All right, let's get into the 5 platforms. Number 1 is Slash. Yes, full disclosure, this is us. Check the hat. Slash is a business financial platform that treats stablecoins as a core feature, not an add-on. You get FDIC-insured business banking, corporate cards, and native USDC and USDT support in one dashboard. There's no separate exchange, there's no wallet management, there's no gas fees to think about. It's great for teams that aren't crypto native. The interface looks like a banking dashboard, not a crypto trading terminal. Slash also offers a global USD account, which lets businesses in over 130 countries hold and send US dollars without needing a US bank relationship. Number 2 is Revolut. Revolut is a digital banking app with crypto trading built in. You can buy and sell over 280 cryptocurrencies, including USDC and USDT. Catch, it's a personal app first. There's no invoice management, no team approval flows, no recurring crypto payments, and fees can also add up. The free plan charges 1.49% per trade, plus a fair usage fee once you exceed about £1,000 per month in conversion. Good if you want to dip a toe in, limited if you need it regularly for your business. Number 3 is PayPal. PayPal lets US merchants accept over 100 cryptocurrencies at checkout, and you can send PayPal's own stablecoin, PYUSD, as a payment. But PayPal is best as a receiving tool, not a sending one. There's no support for batch payouts or recurring payments. Crypto features are US only, excluding New York, and the current 0.99% transaction fee will jump after July 2026. Fourth is Ally Bank. Ally is an online bank that won't freeze your account for sending money to a crypto exchange, which is actually a plus compared to a lot of traditional banks. But Ally doesn't offer any native crypto support. No wallets, no stablecoins, no blockchain transfers. If you want to pay a supplier in USDC, you need to move money out of Ally to an exchange first. It's a solid traditional bank if you don't want to be restricted for using crypto, but don't expect it to unify everything together. And fifth is Coinbase Business. Coinbase is the largest US crypto exchange, and they recently launched a business account with payouts, invoicing, and rewards on idle USDC. The challenge is that Coinbase Business is built primarily for companies that already speak crypto. The terminology, the interface, the workflows, they all assume that you're comfortable with on-chain transactions. It's also very heavily USDC focused, since Coinbase is partnered with Circle. If your suppliers prefer USDT, which has higher global adoption, you might find it a bit limiting. So which one should you pick? Here's a simple way to think about it. If you mostly want to receive crypto from customers, PayPal is the easiest to set up. If you want a personal app that happens to support some crypto trading, Revolut works. And if you're a crypto native startup and you're comfortable with on-chain tooling, Coinbase Business has the building blocks. But if you're running an actual business, you're paying contractors, you're managing payroll, and you're sending money internationally pretty frequently, and you want stablecoin payments to feel like normal banking, that's where Slash fits. Native USDC and USDT support, FDIC-insured checking accounts, corporate cards with up to 2% cashback, working capital financing, insured treasury accounts, and integrations with QuickBooks and Xero so your accountant doesn't hate you. Over 5,000 businesses are already using Slash for this exact reason. And if you found this helpful, hit like and subscribe. We publish guides like this every week about running a smarter, more modern business. To see more of my content, read our blog at slash.com/blog, where I've written over 100 articles to help business owners better manage their money. See you in the next one.